If you work for a not-for-profit, a charity, or a public hospital that offers salary packaging and you're not using it, you could be handing back around $5,000 to $6,000 of take-home pay every single year. CBB NFP provider model. Someone on your exact salary in the desk next to you walks home with thousands more just because they packaged up to the ATO approved cap and you didn't. Hundreds of thousands of charity, hospital and not-for-profit employees are eligible for this, and most never run the numbers properly. So today we'll do three things: audit whether you're actually eligible, quantify the real benefit after fees, and check the super and means test traps that can quietly cancel it out. By the end, you'll know whether packaging genuinely pays for you or just looks good in a brochure. Here's the central number. Eligible not-for-profit employees can package up to $15,900 of general living expenses, rent, mortgage, credit card bills from pre-tax income every fringe benefits tax year, ATO FBT framework 2025-26, plus around $2,400 to $2,650 more for meals and holiday accommodation. But here's the part nobody tells you. Claiming that full cap is only half the story, because what you keep depends entirely on the fees you're charged. 3 moves. First, audit your eligibility and what's already being packaged. Second, quantify the fees against the benefit so you know the real number. Third, check your super and means-tested impacts before you commit. Let's be clear about what this actually is, because it's not free money. The ATO defines salary sacrificing as an arrangement where you agree to receive less cash salary in return for your employer paying benefits of similar value from your pre-tax income. ATO guidance. That reduces your taxable income, which often lowers the income tax and Medicare levy you pay. And for not-for-profit staff, approved expenses like rent and mortgage come out before tax, up to the caps, which can meaningfully lift take-home pay. It's tax arbitrage with strings attached, not a gift. So how big is the upside before anything eats into it? A not-for-profit provider's own table shows an employee on $60,000 gaining an indicative $4,962 a year, about $191 a fortnight, just by maximising packaging. CBB. On $70,000, the same structure shows an annual benefit of $5,088, around $196 a fortnight CBB. Those are real figures, but they're the figures before fees. Now the second layer, because the tax saving can quietly backfire. The ATO warns that salary sacrifice arrangements can affect your reportable fringe benefits amount, which in turn can impact some government benefits and obligations. ATO guidance. For many private sector workers, packaging cars or school fees simply swaps income tax for fringe benefits tax, which your employer may pass back through reduced salary offers. The headline saving and the real saving can be two very different numbers. And there's a sharper cost for higher earners. The ATO notes that if your total income, including sacrificed amounts, pushes your adjusted income above $250,000, Division 293 adds an extra 15% tax on some concessional super contributions, ATO Division 293 guidance. Meanwhile, because packaged benefits lift your reportable fringe benefits, they can raise your help repayment percentage or cut income-tested payments. Even though your cash salary looks lower, aggressive packaging without understanding this can cost you thousands over a decade. Here's the myth that traps people. If your employer offers packaging, just max it out because it always wins. The reality, straight from ATO guidance, is that you must weigh the impacts and costs first. Fringe benefits tax, effects on government benefits, and provider fees, ATO guidance, FAA group. For some workers, it's a clear win. For others, fees and FBT swallow most of the gain. Put the two costs side by side. Typical provider fees of around $20 a fortnight come to $520 a year, more than 10% of a roughly $5,000 benefit, FAA group. And underusing or skipping the caps can forego around $150,000 to $165,000 of tax-efficient pay over a 30-year career, illustrative from CBB figures. Same mechanism, opposite outcomes. It all hinges on fees and how fully you use the caps. Meet Emily. She's 32. A registered nurse at a not-for-profit hospital, earning $80,000 a year. Her super sits at $65,000 in an industry fund, and she's 33 years from retirement. Her employer offers salary packaging through a third-party provider, and until last month, she'd never touched it. Here's what Emily found. Discovery 1. The missing $5,000. Emily's provider table shows someone on $70,000 gaining an annual benefit of $5,088, about $196 a fortnight, CBB. At her $80,000, HR explains the indicative uplift is similar or slightly higher, potentially $5,500 to $6,000 if she packages the full $15,900 plus around $2,650 in meal and holiday benefits. She'd effectively been forgoing 7 to 8% of her net pay every year. Discovery 2. The fees nobody showed her. Reading the FAA Group's guidance, Emily learns providers charge fees that vary widely and can materially erode the benefit FAA Group. Her own provider's disclosure shows a $20 per fortnight admin fee, $520 a year, plus a one-off $100 setup fee, so $620 gone in year one and $520 every year after. Against an expected benefit of $5,500 to $6,000, that's roughly 10% she was never warned about. Discovery 3. Super versus living expenses. The ATO confirms salary sacrifice super is additional to the compulsory super guarantee and can't reduce it. ATO guidance. Emily compares sacrificing $5,000 a year into super versus packaging $5,000 of living expenses. At a 34.5% marginal rate, each path saves roughly $1,700 to $1,800 in tax. But super locks the money until retirement, while living expense packaging keeps that cash free for everyday life. Same tax mechanism, very different trade-off. Add it all up across Emily's career. After fees, a net gain of around $5,000 a year, compounded over 30 years, comes to roughly $150,000 to $165,000 of foregone tax-efficient pay, illustrative from CBB and FAA Group figures. And that's before any investment returns she could have earned on the extra cash. That's the real cost of leaving it in the too hard basket. So, could this be you? Sign 1. You work for a charity, hospital or not-for-profit, and you don't package anything at all. Sign 2. You genuinely don't know what fees your packaging provider charges. Sign 3. You've never checked whether you're using the full $15,900 cap. If any of those land, the next 3 moves are built for you. These 3 moves take under 20 minutes each and they're completely free, but they're the difference between packaging that genuinely pays and packaging that just enriches a provider. We'll confirm you're actually eligible, measure the real benefit after every fee, then check the super and means test traps that catch higher earners. Do them in order and you'll know your true number, not the brochure number. This is general information, not personal advice. Move 1. Audit your eligibility and what's already being packaged. Log into MyGov and use ATO online services to confirm your employer's type. Whether it's a public benevolent institution, a health promotion charity, or another not-for-profit eligible for FBT concessions, ATO guidance. Then pull your latest payslip and any packaging statement so you can see exactly what's being packaged today and whether FBT is being charged. 3 quick steps. 1. Log into MyGov and check your employer's ABN and organisation type. 2. Confirm it's an eligible PBI, health charity or not-for-profit. 3. Request your pay slip and packaging statement. Good looks like clearly itemised pre-tax benefits and no unexplained cut to your compulsory super. Move 2. Quantify the fees against the benefit, because the headline number means nothing until you subtract costs. Use a not-for-profit salary packaging calculator, enter your gross salary and employer type, then your planned amounts up to $15,900 for living expenses and around $2,650 for meals and holidays. CBB, ATO. Finally, subtract every provider fee in your agreement to land on your real net benefit. 3 steps. 1. Input your gross salary and select your NFP or health employer type. 2. Enter your planned packaged amounts up to the caps. 3. Subtract provider fees, for example, $20 a fortnight, which is $520 a year. Good looks like a net benefit after fees of at least $3,000 to $5,000 when you use the caps CBB. Move 3. Check your super interactions and means-tested impacts before you go all in. In ATO online via MyGov, confirm your salary sacrifice super is recorded as additional concessional contributions and that your super guarantee is still calculated on your full pre-sacrifice salary ATO guidance. And if your income, including sacrificed amounts, is near or above $250,000, read the Division 293 guidance, that extra 15% tax can halve the concession on part of your contributions. 3 steps. 1. Open ATO online to view your year-to-date income and employer super. 2. Confirm sacrifice super is additional and your SG is on your original salary. 3. If you're near $250,000, consider capping concessional contributions. Good looks like SG on your full salary and contributions kept below the Division 293 bite. Why act now? 3 dated shifts explain the urgency. In 2012, Division 293 introduced an extra 15% tax on certain concessional super contributions for high earners, ATO. In 2017, the income threshold for that tax was set at $250,000, directly hitting heavy super packaging strategies, ATO. And every fringe benefits tax year, the ATO maintains and adjusts the concessional caps, the $15,900 living expense and the $2,400 to $2,650 meal and holiday amounts, CBB, ATO. Check current figures before you commit. Once you've acted, verify it actually worked. You should see itemized pre-tax benefits clearly on your next payslip. Confirm your super guarantee is still calculated on your full pre-sacrifice salary, not the reduced amount. And if your net benefit after fees comes in under $3,000, that's your signal to renegotiate the fees or rethink the arrangement entirely. Everything today comes from the ATO's salary sacrificing and Division 293 guidance, plus indicative figures from a not-for-profit provider and the FAA Group's analysis of packaging fees. All the links are in the description below so you can run your own numbers. Don't take our word for it. Check the source. So now you know how to tell whether salary packaging genuinely pays for you. The caps, the fees, the FBT, and the super traps. Next week, we're pulling apart novated car leases. Are they really a tax win or just a dealer's trap dressed up as one? Subscribe so you don't miss it. If this saved you from leaving thousands on the table, do one thing for us. Hit subscribe so we can keep reading the fine print on your behalf. We publish one of these every week, and the next one could be worth real money to you. Thanks for watching The Fine Print.